So this is about MMPF 004 security analysis and portfolio management. I will welcome to the new session of security analysis and portfolio management. I would like to do a little bit of recap what we have done earlier sessions, what we have covered. In Unit 1, we have covered Introduction to Investment. That is the basics of where you save and what is investment. You take a little bit of risk, expecting a better return. Then in Unit 2, we studied securities market, that is capital market and money market, and etc. And we would understand where from to buy the securities, where to sell the securities, etc. In Unit 3, we went further down. We wanted to understand risk and return. After all, if I save my money in a bank, my money is technically riskless. I mean, I will get my principal back. I may get a lower rate of interest. But if I take risk and I put my money into equity market or real estate, another thing, the probability or gold, the probability is that I will get a better return, but at the same time, I'm taking a risk. The price of the material, price of the securities, if I can say, we may or may not go up to your expectations, and that is the risk. What is the risk? Risk is you expect a return, but in actually you don't get that return. That is the risk. And the return is generally determined by the market forces, whatever return they will give, and also companies' performance and many other things which we'll learn slowly. Finally, in the last session, we studied about investment theories, the various theories in which we focused on efficient market hypothesis. We understood that, we explained rather, there are markets in which all informations are not available with everybody, which is a very weak form of market. Then there is a market where almost all publicly available information are with the public, so that is a strong form of semi-strong form of market. So that I am sitting in Mumbai and I have the information, and you sitting in Ranchi, you also have the same sort of information, and then you can also take your call whether to buy this security or not, etc., etc. But after that, we went another farther, which was a basic benchmark, which is very idealistic situation, which is very strong form of market. That is a efficient market hypothesis. There we explain that if all the available information, either publicly held or privately held, are available with everybody, then you do not have a chance to take advantage of some information which you have and make some extra money. So that is a very idealistic situation, as we have discussed earlier. So what will happen is that, as we have discussed at that time, that most of the markets are semi-strong, in the sense there are information which is available with you, there are some information not available with you. And this creates a information asymmetry. So if you do not have some information and somebody has some information, and if the information is of value, then you can take an opportunity to use that information to make investment and get some return, which is better return than if you didn't have that information. So these three theories we studied: efficient market, semi-strong, poor, and very strong. And we also explained that if we go for a very strong market theory, then the question of any analysis and anything doesn't come, because all the information are available. But in reality, it is not so. So this is a small recap of what we have covered. And from there, now we will move into security analysis. So security analysis is basically when you systematically try to understand a security. Let us focus on equity, whether it is worth investing or not. Today we will be studying economic analysis, and before that, I will go to the introduction to the security analysis. Now, primary motive to invest is in a security is to sell later at a higher price. You also get a dividend if it is in equity, or getting regular interest considering the risk. That means if you are investing in Sriram Finance, you will be getting a higher return. But if you are investing in an HDFC bond, then you may get a lower return. So this interest depends on the risk you are taking and getting the principal back, debenture and bond. So you do study on that and you decide whether I should be investing in this or not. So, however, we will discuss here on equity investment because the plenty of studies are being done on the thousands of companies which are listed in the stock market, and that is a equity analysis or security analysis. Prima facie, we understand by security analysis the equity analysis, and we try to analyze it from various angle and then try to get the value. This value can be called intrinsic value. And if the market price is low, please listen to my word very carefully. Suppose you analyze and you find that actually, as of now, let us take it for example, ITC is not properly valued. It can go up further. So there is an intrinsic value in here, but the market price is 400 something odd, but the price can go to 450. So there is an intrinsic value and there is a market price. So if the intrinsic value is more than the market price, you will like to buy the share with the expectation that it will be going up, and you will sell when it reaches the targeted return. So this is about the equity investment. To get required return at a given risk, we need to analyze the security in a logical and systematic way. Let me read it out again. To get required return at a given risk, mind my word, to get a required return at a given risk, this means you are taking a risk. Suppose you want to take a return on DLF, real estate, or you want to take a return on Bajaj Finance or some another finance company. You are taking risk. And whether the return you are expecting justifies the risk you are taking. We need to analyze the security in a logical and systematic way. So, we must understand if I want to buy the particular stock, what is the risk that it may not give the return? So it's a game of probability. And what is the risk that it can give a more or less similar return? Considering that, I will do an analysis, which should be systematic, statistical analysis and other tools you will be studying in your study material. And then you can say ki at this price, the risk seems too low. That means you have margin of safety. So you can buy this stock, and the probability is that the stock price will go high and you will make some money. So this is what is in a very short way, what is security analysis. We'll go deeper later on. Now, broadly, there are two approaches are suggested. These are fundamental analysis and technical analysis. Now, if I go back to the fourth unit of the last session, we talked about hypothesis, market hypothesis, efficient market hypothesis. Now, there we said in the strong form that if the all information present and future are available with public, then there is no question of taking price advantage. So that negates my idea of fundamental analysis. But in technically, no market, be it US market or European market or Indian market or Hong Kong market, is not perfectly strong market. These are all semi-strong market because there are always some information with the research analyst, the information with the top corporate CFOs and CXOs or board members, etc. So there are chances that, or your analyst who can forecast certain things and understand if this can go higher. So there is a lack of uniform information across the counter. So this is what where fundamental analysis comes into work. Second is technical analysis, which again in your efficient market hypothesis we said how the company has behaved earlier doesn't matter. But technical analysis is grounded on the fact that how it has behaved in the last 200 days or 50 days and other things, and how, given the coming scenario, how it like to behave, how much volume it has been traded, whether there was a gap or something or not, etc. This is technical analysis. But my focus in this today's presentation or this session totally will be more on fundamental approach. In the fundamental approach, various fundamental and basic factors that affect risk return of the securities and cash flow are examined. I repeat, in the fundamental approach, various fundamental and basic factor that affect the risk return. ये risk बढ़ा देता है, return बढ़ा देता है, or return it is not increasing, but it is increasing the risk. And how does it affect the cash flow? Because ultimately cash is king. So we need to understand, need to study this. So this form of analysis called industry and company analysis, EIC framework, where we use economy, industry and company analysis model. So this is a model which you will be using for fundamental analysis, and I'm sure you will be finding it very interesting. One thing I will request you all, please be with me so that because we will be going into certain data and figures which are very important to understand the market, and then we'll go ahead. Now, what is EIS framework in general? There are two general approach to the process when you make an investment decision. One is top-down, three-step valuation approach, and the other is bottom-up stock valuation approach. Bottom-up stock valuation approach, bottom-up stock valuation, bottom-up stock valuation approach, and top-down three-step approach. Top-down in the sense, I first see how the economy or the broad factor, macro factor, how is the scenario. Then I look at what is the, suppose you are thinking, can't invest, where I invest. Then first I try to see how is the whole thing is coming. And in the sense, the broad picture, the market is doing well or not, overall psychology of the market, economy is doing well or not, etc., etc. And then we come to the industry. Suppose cement, how is cement doing? Whether there is a push in the infrastructure, whether there is a housing boom is coming or not. And then if I find this is okay, theek hai, then I try to move to the company, which in the cement sector, which company is doing well. And there are certain parameters to judge. What do I mean by doing well? So this is a top-down approach. The bottom-up approach is something different. There I identify there is a good stock, suppose Zomato, it's a good stock, and then I try to see it is in which industry. It is a delivery industry. Now, who are the competitors? Swiggy and other things. The whole broad factor is there is a huge generation of new generation people, double working people, They will be ordering their food. In fact, they can order other things also, which they deliver. They want it fast, so you have 1 hour service, 10 minute service, etc., etc. So this is a bottom-up stock valuation approach. You identify the stock first, and then try to see how the industry is trying to shape up and how the economy is going to sustain that stock. So there are two approach I discuss: top down, where you look at the economy first, and then the industry, and then try to see how they are affecting the stocks and its cash flow. Second approach is bottom up, where I identify the stock and then try to see, yeah, okay, in the industry, whatever happens, what happens to this company, whether it company can survive or do give a better result or not, and overall scenario is conducive for this company to do well or not. So the three-step approach believes that a firm's revenue are considerably affected. Three-step approach first, okay, believes that a firm's revenue is considerably affected by the performance of the economy and industry, and thus first step in valuation process is to examine economy and industry and their impact on firm's cash flow. Now it's a long sentence, let me break it down. The three-step approach, we first have to think economy. Indian economy, let us look at that. If it is doing very well, then question is that which industry is doing well. I can say that if you look at the Indian economy, now there is a lot of emphasis by the government in the semiconductor or defense manufacturing, Bharat defense manufacturing, etc. So I can say that this industry, if I am looking for investment, and recently they have given nuclear power plant, also they have allowed private sector to move in. So the question is that whether the broad economy can sustain this thing, and the industry, that is, say I tell you the industry, semiconductor industry, who are the player, who are the big player, and etc. And if I narrow down in a company or solar industries, there's a lot of thrust by the government about solar industry, and there is a lot of companies, Adani Solar, Adani Green, etc., Wari Engineers, etc. And how this economic policies and industries card your dynamics of internal fighting and internal competition, I not say fighting, competition, how they're going to impact the company we are bothered, that's cash flow. I hope I have made it clear that the economy and then the industry and then finally how they affect the cash flow of the company I'm focusing in. Well, then I can change the company I should focus in. Bottom-up approach believes that it is possible to find stocks that offer superior returns regardless of the market or industry outlook. So it's a very simple, clear. They say you identify a stock which has a potential, which has a good market share. Maybe whatever happens to the industry or market, they will do well because they have a good market share. They are economy, they are approaching, so market outlook jo bhi ho, they will make good money. So in a short period, I can make some good money, or in a long period if I were ready to hold it for a longer period. Some example of this, I can say, you can identify with the bottom-up approach some of the chemical companies or some of the like Jubilant Organics, which makes your Domino pizza or something like that. They can do well. Or recently listed Misho. Misho recently listed. Whether the industry does well or not, it has a platform which is most demand, and they can go up. So this is the bottom-up approach. Now let us move to next one, that is EIC framework, what it is. So far I have talked about EIC. It's a way of fundamental analysis. 6, the intrinsic value. I have already told you, fundamental analysis may we try to get the intrinsic value. So the first step in this fundamental analysis is economic analysis, which we will study today. Second stage, इसमें हम क्या देखते हैं? What I see here is that GDP, that is gross domestic product, that is how the country's economy is doing overall. Is it growing? GDP, if it is growing, that means there is a lot of production, there is a lot of employment, etc., etc. Inflation is benign, interest rate is moderate, political stability is there. All these things are there in the economic analysis. Followed by that, we'll do the industry analysis, characteristics of the industry. Now, if you look at cement industry, for that matter, now there are two large players. If I take Adani's Ambuja Cement, ACC Cement, and now Orient Cement, they three is a group, and Ultratech. These two are the major share of the market. And then there are small companies or chota companies. So the characteristic of industries is that it is controlled by two giants and followed by many small entities. And what is government policy, that you have to check it whether it is supporting the biggies or it is also supporting the small units so that they are not out of the industry. They can make money and they do not go for bankruptcy or something like that. And finally, we come to the company analysis, in which we try to understand the profitability, efficiency of which company is functioning, what is the future growth prospect of the company, whether the company's asset turnovers is good or not, or company solvency is good or not. That means even if it is a bad time comes, company can survive and can maintain its solvency or not, etc. So these are the various factors, and its debt equity ratio is okay. So these are the things we study in the company analysis. So three analysis: E for economic, I for industry, O, C for company. These are the fundamental analysis, 6 intrinsic value. From there, if I get intrinsic value, which is higher than the present market price, then I can go for this stock. Because I know after some time, market will get this information and the price will go up. So this is one way to selecting a stock or analyze the security. Now let us look at the bottom-up approach. I told about EIC framework, and I have earlier told there are two approaches. One is bottom-up or one is top-down. So first let us know bottom-up. Bottom-up mein, you analyze the company, then evaluate the management, examine the key financial ratios, analyze the sector, and consider the broad economic conditions. Now let us say I have identified Dr. Pathlab, Dr. Lal Pathlab. Now I find this company has many places they are collecting blood and they're offering diagnostic services, etc. The management is good, their logistics and the supply side is good. Then if I move to examine the financial ratios, it's good. Then I come to the sector. Now there are a couple of things. Thyrocare was one which was there. Apollo is there, quite big, but not so fragmented in the sense they are generally they have a big setups, unlike Dr. Pathlab, which has a small franchisee type of setup. And consider the economic condition. The healthcare sector will be doing well, come what may be, and diagnostic is increasingly become important. So the Lal Pathlab will do well in the coming future. So this is a bottom up. I didn't go for how the healthcare sector, what are the verticals in the healthcare sector, hospitals are good, or diagnostic is good, or pharmacy is good, like that. I did the bottom up. I said the company, Dr. Pathlab, Dr. Lal Pathlab is a diagnostic company. Now let's see the management. How is the management? Please note, management. How is the management? Whether they are managing it efficiently or not. How is efficiently? I will come to know. Examine the key financial ratios. So, key financial ratios we have profitability ratio, we have solvency ratio, we have efficiency ratio, we have profitability ratio. So, if these ratios are good, that means the management is running it quite efficiently. Now, if I look at the sector, who are the competitor? Thyrocare, there are many small players are there, local players and other things. Apollo is one of the big player, and also there is one Thyrocare which was a big competitor, but slowly it is not, it is losing ground. And the economic condition is that health sector there will be demand for treatment, and there will be demand for diagnosis, and then the doctor path lab, because of its accessibility for the patient, they can have a good growth. So I can, this is a bottom up approach I can adopt. Now, what is top down approach of fundamental analysis? Analyze the economy. You analyze the economy, how the economy is doing well. In the economy, when I say that means that's a big picture. There is gross value added, gross domestic product. Okay, the economic, what is the inflation rate going on? What is the interest rate going on? FDI कितना आ रहा है? Whether we are exporting enough or not, or our international trade कैसा चल रहा है? All these things are the broad picture of the economy, and we'll see that economy, and because each factor has an impact on the industry or the companies. So this is very important to understand the analyze the economy. Second step, may we evaluate the industry. So once you see the economy, I just told you that economy maybe solar power is good industry. You narrow down. Yes, it has a good potential because India is maximum day is sunny day, and there are big players. Also, there is room for small players, from rooftop solar installation to Gramin solar installation to industrial solar installation. There is a various scopes, and there are industry is growing because we have a very big target to replace the fossil fuel, and government is also giving a lot of incentive. So the industry is in a good book of government as of now. Now I study the company. Out of these companies, which companies are doing well? I see Adani Energy, I see Wari Engineers, and there are some more companies that there, Tata, BP Solar, etc., etc. So I study the companies now who are making a good product, who are making efficient operations, who are good in installations and other things. So I compare with the competitors. So 3 and 4 are simultaneously done. I compare with the competitors and try to identify, if I go for it, which one I should choose, which company I think I should choose. There is a management, there is efficiency. I told you earlier, there is management is good or bad. There is efficiency, they are running it or not. Are they growing or not? Are they innovating or not? Etc. etc. And what are the risks in this company? Are they not developing new products, or they are not doing some research on this, or they are not trying to increase the efficiency of their solar module? So all these top-down approach way I do analysis. It comes step by step. It comes initially. It comes economic analysis, which we will be studying today, and then we will be studying industry analysis. Then we'll study company analysis and competitors and risk. These three, four, five. So from there, we will narrow down on the company which, based on our analysis, unbiased analysis, may be a good one to invest. Am I clear? I hope we have covered up to what is top-down fundamental analysis and what is bottom-up financial analysis. And this financial analysis are fundamental analysis. We are not going for technical analysis. Now, I will move to some data. So please be with me because these data will tell a lot of things. Today's world is data analytics. So data, I could capture less data because more data are available in the Google or available in the open internet. You can go through these data and try to understand how do I study. I'll also at the end I'll tell what are the different sources from where you can do the macroeconomic data. Okay, there is Ministry of Statistics and Program Implementation (MOSPI), Ministry of Statistics and Program Implementation (MOSPI). That's the Government of India. National Statistical Organization (NSO), Government of India. Then IBF, Indian Brand Equity Foundation, that's the Government of India. Beside that, there is Bloomberg, Reuters. They are publishing various fundamental analysis reports, trading economics. So these are then all the newspaper, most of the business newspaper, they have their own research team and they publish the macro report as well as industry report and sometimes, of course, company reports. So these are the sources you have to access if you want to do your fundamental analysis, whichever way you want to go, bottom up or top down. Now let us look at economy. Now gross domestic product. Now gross domestic product is nothing but your consumption, your government consumption, that is government spending kitna hai, and then you have investment kitna hai economy mein, and then import minus export or export minus import. So this is your GDP, gross domestic product. Now I have not given here, you can get it from anywhere, the trend, but I have said in the global scenario how India is now doing well. Now you will see the black row is estimate 2024 का, because the final results आते थोड़ा time लगता है. 25 का forecasted figure and 26 also forecasted figure. So you know the figures. Now this is taken from the World Bank. So World Bank is also another source, and OECD, Overseas Economic Development, OECD. So that's also another source of development. Asian Development Bank, another source of information. So these are the places from where you have to find the sources. Remember, if you're doing fundamental analysis or you want to be a equity research analyst, you have to go to the lot of source of information so that you can have most of the information which are available in the public domain. Remember, we studied about a hypothesis, efficient market hypothesis. If you have most of the information with you, you are very close to that strong form and you can take the profit arbitrage or price arbitrage very well. What do you mean by price arbitrage? You can understand that I can estimate the price much better than many people who do not have those information. So following India, you will find China, then Indonesia is doing very well. US is, please note that US is basically a very big economy. So is China. Then Euro area and then world. The world is 2.7 and we are at 6.5. So our growth is really good. And if we can maintain this growth, then there will be economic growth in the sense there will be more people employed. If the more people are employed, there will be demand for goods. If the demand for goods, there will be more factories coming. More factories coming means more employees will be required. If more employees are required, they will earn salary. So they will also demand for goods. So there will be a demand for goods if the GDP keeps growing, right? And if the demand for goods comes up, then automatically the industry and the economy will start moving up because you have to produce those goods. And the moment you produce those goods, it goes to there is a demand in the market, and those who are producing the goods, they are also earning, they are also creating demand for the goods, and we are into the cycle of growth. So this is very important to note here that Indian GDP is now one of the outlier in the world, and we are doing well considering the other countries in the world. So economy from the GDP front is quite sound. Okay, there may be some fall as of now. There are some last quarter we had 7.2 quarterly. This GDP is published quarterly, and the quarterly we can move up, or generally rainy season may there is a less GDP growth, but when it is a Diwali session or something, there will be more sales and other things, so GDP will grow up, etc. So you have to understand the trend of the GDP. If the trend of the GDP is zigzag, then you have to keep a notice, you have to be careful. But if GDP is growing linearly, meaning slowly it is growing up, incrementally it is growing up, then you must realize that in the bhitar ke economy mein things are doing well. That is why GDP is slowly going up. And if we have almost 2%, 1.5% above China, or 1.5% above Indonesia, so we are growing, and there is a E minus I, that is export minus import. So our imports are generally more than the exports, so that reduces our GDP to some extent, but still our total mass, our consumption, government's investment in infrastructure, and also the exports, I'll come to it later on. These all has creating a factor of GDP growth. So what did I say? The consumption of the people, because the inflation, I'll come to it, low and other thing. GST has come down, you know that price has come down. So people buying power has gone up. Then you have government investment in infrastructure. Then you have private investment, semiconductor. Then your investment in solar power, investment in various startups and etc. So there is a good amount of investment by them. And even if there is export is less than import, our overall GDP growth is solid and one of the best in the world as of now. So if this remains so, this is a good indicator that you can invest in this economy. Look at from outside. If this is the situation, then you from US or you from Euro area, you may think, okay, India economy looks good. Why not I invest something in India? Other things I have to go through in details, but we can keep in our radar India, right? Now let us come to the next slide. This is the inflation rate. Now inflation is something which is like a termite. It corrodes under. Suppose your inflation is 10% and your bank deposit is 8%. That means, I have discussed it earlier, your real interest rate is negative 2%. That means aapka buying power is coming down. But if we see from July 24, there was a spike, it went up, but after that it is coming down. In fact, it is now 0.43 or something like that September figure. It is up to July. And this is the food consumer price index. This is we are important, and this is food का है. Okay, consumers food price index and consumer price index. We are bothered about the red one, consumer price index. So if you see that consumer price is 1.55 July, now it is less than 1. So that means inflation is benign. Benign का मतलब है it is very low. Now if inflation is low, technically what it is, the price of commodities have come down. If price of commodities have come down, that means I, with the same 100 rupees, I can buy now more. Or the other way I can say my buying power has gone up. Now if my buying power has gone up, then I will buy more. And if I buy more, then the producer will try to produce that demand. So the production will go up. If production goes up, then you need employees, you need machines, etc., etc. So the machine manufacturer will also employ people, and new employees, they will also get salary, and they will also try to spend. So we will be in a cycle in which the demand is growing in the economy, and to fulfill the demand, the economic growth is happening, and what happens is that it brings in a spiral growth in the economy. So I am coming to an economy which, first of all, had a very good, strong GDP, and second, which has a good buying power. Inflation is low, and there is a growth in demand. Right. So there is a growth in demand. Now I'll move to the next one. Now, if you have not covered, I will just repeat once more inflation wala. Inflation and nominal rate. What you see on print in the bank or other places, the interest rate, that is generally nominal. So if they say it is 5%, then it is a nominal rate 5%. But if you deduct the inflation, say 1.55, then you get the net effect, that is 3 point something, 45. That is the real interest rate you are earning. Now that's not bad, that's quite good. This is the real interest rate. Whereas if the inflation is again more than 5%, that means you are losing the value of your money, and this is very important. So if you're losing your money, value of your money, some investors will not come because I lose my value later on. So let the inflation come down, then I will think of coming to the country. So the investor may slow down. But as of now, India the inflation is low. Consumer price inflation is low, consumer food price inflation is farther lower. So we find that this low inflation will give the demand, and will create buying power in the hands of people. So there can be a growth. This is a trade statistics. The third part. One is internal ho gaya. Now third part pe if you see, we are April to September only I have taken, and you can see here my April to September 24-25 was 213, here 220, so 3% change. Mind you, this is in spite of the fact that government of India is facing tremendous pressure from US, number one. Number two, geo-economic situation is also not very sound. Okay, other countries are also facing problems and etc. In spite of that, India is diversifying its export and also trying to keep control over import. Import is not bad. Suppose I want to make Apple phones, I have to import the components, then I'll add value and make the final phone and I export. So import will also go up if I want to go up my merchandise, that is like phone, the merchandise export मैंने जो दिखता है बिकता है, like that. And service, we are always good, like in travel, like software, etc., etc. So there also you will see that the growth is, export growth is 6.12%, but your service import has come down. Now this data is from RBI for August 25, September 25 is an estimation. So you can always estimate or appropriate future and try to understand how the economy or how the economy is going. So to sum it up so far, what we have covered, GDP is sound, it is globally going very well, number one. Number two, my inflation is low, so the demand for products will be high. And if third is my exports or my international trade is increasing in spite of all odds against India. So geo-economic problem hai America ka, and also some of the countries. But in spite of that, we are entering into FTA, free trade agreement with different countries, and bilateral trade agreement with some countries, and we are increasing our export as well as import. So merchandise and service import export is also growing. So these are all indicator of a happening economy. Now let me come to a all packed economy, interest, inflation, GDP. Now, this is a data taken from, as I mentioned it here, source RBI, MOSPI. I was talking about you, MOSPI. You can note it down, RBI, MOSPI, Bloomberg, compiled by Business Standard Research Bureau. So these are the places from where you will get the data, okay, which will be useful if you want to make a career in security analysis. So downward cycle, repo rate is the rate at which bank RBI lends money to the commercial banks. Now, if commercial bank gets money at a lower cost, they will also pass on the lower cost to the industries. So industries' borrowing cost will come down. I repeat it again. If RBI reduces the repo rate as it is 5.25 in December, so the banks will borrow from RBI 5.25. So banks can now lend say 1%, 2%, ऊपर रख के 7% में 7.5% में, like that. Bank can lend, and if bank is lending at a lower rate of interest, industries will be interested to borrow from bank and expand their capacity, setting up new plant, etc., etc. So this downward cycle of interest rate is conducive for more investment into the economy. Next, CPI inflation. As I told you earlier, it was 4.83. Now it is 0.25, October 31st, 25. I was telling you it is below 4.40, 0.25. So now, if you really look at it, you are enjoying a real interest rate, 5.25 less 0.25 inflation, 5% is your real interest rate. So it appears that interest rate will go further down, because real interest rate generally is 2 to 3% more, 2 to 3%. What do you mean by that? Your inflation will be eating up some amount of you. You want to earn more than that. And that more than is generally 2 to 3%. But here we find it is almost 5%. So there is a chance that interest rate will be reduced further in future. And these are the forecasting which will be done by the economists and intellectual people, and based on which the companies and others, they will take decision, okay, this is the time, raise money in a big way or wait for some more time. so that I can raise big money and for my investment. Or if I have loan at a higher cost, I can borrow at a lower cost and repay that higher cost money. Like this, the company will reorganize their business because the economy is doing well with a downward cycle in the repo rate, inflation is less, GDP may we are one of the toppers, etc. Now, changing projection, RBI forecast in inflation. If you see it here, RBI projection is this is farther down in December. Quarter 4, FY26. FY26 means March 26. Quarter 4 means January to March. This is October to December. So again, less FY26 overall from 2.6 to 2%. I'll just try to tell you one thing. Government of India has formed a monetary policy committee which is supposed to maintain the inflation at 4% plus minus 2%. That means 6% and 2% is the corridor they should maintain within that. So now the inflation rate is more or less within that corridor. It is 3.9, 2% throughout the 26. So it is in the lower end of the government mandated target. So this is RBI's forecast, which is quite reliable. And GDP growth rate, again, we saw 6.5, but RBI is now forecasting it is 6.7. And maybe next quarter 2 FY27, March 27, that means financial year 26-27 May, it will be crossing 6.7, it may go to 6.8 if the economic conditions of the country, macro conditions remain so. So if you look at it, you will find this summing up slide that if the economic overall scene like GDP is sound, it is growing, inflation is low, so the buying power is there, interest rate is low, so the company can borrow, company can expand, they can think of growth. So this is the ideal atmosphere for investment. And then you should look at the companies or industries or the sectors where the government has more focus or which will be beneficial for this economic brownie points. We are not touching this point, likely impact of rate cut, because there's no point in reading this. So we are just touching on the inflation, interest rate, GDP, the overall growth rate, as well as I told earlier slide, I told you in the earlier slide, the export or our trade. So that in spite of this problem, geopolitical problem, another thing, geo-economic problem, America trade blockade, another thing, we have diversified our export basket, and that will be a long-term benefit because we will be exporting to them not now only, even when America we enter into some sort of trade understanding, but still these countries or the places where we have started exporting now, we will be exporting to them also. So our export basket will be much more diversified, which is also good for a growing economy. So from the economic analysis, as of now, what I have told, it happens so that the market looks like it is really good. So you are getting all sunshine things, but sometimes if the GDP is not growing that much, inflation is high, then one has to be cautious whether this is the time for investment or not. So if these are the good time and you should invest, it's fine. But if these are not happening, inflation is high, interest rate is high, GDP is not growing that much, then shall we invest, or you will rather remain cash, or you will invest in the bonds or debentures or whatever it is, You should think of it, where to park your money in case. But as of now, the Indian economic broad pictures, broad review of the Indian economy shows very encouraging sign for investments. Summing it up, economy in good shape, fastest growing GDP, low inflation, increase in buying power, falling interest rate, demand effect. Falling interest matlab demand effect. Suppose interest rate has gone down, you don't mind buying the car now, then postponing it later on. In spite of troubled geo-economic scenario, our external trade is growing. Now, if external trade is growing, that means we are producing and sending it to the globe. So that is local production is going up. If the local production is going up, then the factories will be running, employers will be getting paid, and they will create further demand for the local domestic market. So the economy is suitable for investment in securities, of course, after due diligence and proper analysis. So here is the main catch. Economy is looking suitable for investment. But you need to understand which sector I should focus or I should try to go deep into which sector I understand, and then I should do the proper analysis of the companies which can take most benefit out of it. Most benefit, matlab, which can generate very good cash flow because of these advantages of the economy, and then only I can choose. I can say my equity analysis is being done, and we will be studying the next other part, that is economy. Today we have covered fully, more or less, and we have told that there are three, four, five, six things which are very important and which are, if the positive indicator, that means economy is in a sound footing. Beside this, there are other macro factors. I'll just quickly read it out. Anticipatory survey. This is a very simple method through which investor can form their opinion. Like I told you, RBI was giving some anticipatory survey that GDP will grow, inflation will come down, etc. like that. Government policies, we have seen the government is encouraging solar, government is encouraging PLI, that is incentive, one top of incentive to the manufacturers, etc. So this will bring in investment into that areas. Like you might have seen some people, they are focusing on to the pharmaceuticals, somebody is focusing on medical equipments, somebody is focusing on, depending on their competitive advantage, and government policy. Fiscal policy. Fiscal policy is basically government spending and tax action is part of demand side management. That means, what do you mean by demand side management? Is that I want to maintain the fiscal balance so that I spend money in the infrastructure, there is a demand created, and I have to maintain the fiscal deficit in a limit. Monetary policy is RBI control, and they maintain a flow of money, so which is not enough, which is enough for the inflation to be lower side, and they want to maintain that so that the inflation is low, so that they can keep the interest rate low. Leading indicators, as the sum suggests, there are indicators that lead economic activity in terms of the outcome. Some of the leading indicators are, if we can forecast that, okay, we have discovered certain things which can lead to the growth, there is a demand for these things coming up. So these are the leading indicator. Lagging, which is like you see now, the electric consumption has gone up. So that means there is industrial production, because domestic, they cannot push up the electricity consumption. So these are the lagging indicators. When the data comes, you come to know that industry is doing well. So there are a lot of electricity consumptions and etc. So with these macro factors and understanding the economy, you can broadly understand that economy is doing well or not, and accordingly you can move into the next stage, which is we'll cover tomorrow, next class, that is industry analysis. So thank you very much. I complete with you today the economic analysis part of the security analysis. In the next session, we will be covering industry analysis. And as I have covered you, Indian economy is looking good, and so Indian investment is looking good, stock market is looking good. And if you analyze and if you can develop the skills, you can be a good equity analyst. Thank you. All the best. And Merry Christmas.